Hello, good morning everyone. Today our group will be presenting on the problem C11-1, Target and Walmart. The problem presented reads as follows. Target Corporation operates in a single business segment that is designed to enable guests to purchase products seamlessly in stores, online, or through mobile devices. Most of its operations are in the United States. Walmart is engaged in the operation of retail, wholesale, and other units located throughout the United States, Africa, Argentina, Brazil, Canada, Central America, Chile, China, India, Japan, Mexico, and the United Kingdom. The company's operations include three reportable segments: Walmart US, Walmart International, and Sam's Club. Shown here on screen is the list of long-lived assets of Target, including land, buildings, computers, and constructions, along with their useful lives. The word problem also gives us data about the companies that are not seen in the financial statements. This is the list of information about Target that was listed.
For question 1, we are asked to estimate the average useful life of each firm's long-lived assets as of January 31st, 2015. So we know that using the straight line method to calculate for depreciation expense, we have to divide the value of the asset by its useful life in years. So if we use this formula and we just turn things around, we just flip around the numbers. In order to calculate for the useful life in years, we're going to be dividing the value of the asset by the depreciation expense. These are the values that are given, so this is how we're going to calculate for the average useful life in years. So first, let's take a look at Target. What we have here in front of us is Target's property and equipment values for January 31st, 2015 and February 1st, 2014. What we're going to have to do first is to calculate the sum of the gross of the property and equipment, gross meaning before depreciation, and for this we're going to be excluding land and construction because what we're going to look at is depreciation expense, and for land doesn't depreciate. As for the construction that is still in progress, we're not going to be depreciating that either. That's why we're going to be excluding these two when we calculate for the sum of the gross. So if we add up all the values, excluding land and construction, that is 26,614 plus 5,346 plus 2,553, we get a total of 34,513 on the left side. That's for January 31st, 2015. And we do the same for February 1st, 2014, and we end up with $33,578 for the gross property and equipment value for Target. Now, since we have the financial information for 2 years in front of us, and we're trying to get the average useful life in years for the company, a more accurate representation would be to take the average of the 2 years. So we're going to take the average of the gross of the 2 years so that we don't just consider one value, but we're taking in consider both values here. That's why we take the average. That is, we're going to add 34,513 plus 33,578 and divide this by 2 to get the average of the gross. That will give us an average of $34,045.50. Now that we have the average of the 2 years, we take now our depreciation expense and we divide the average divided by depreciation expense, and this would give us the useful number of the average useful life in years for Target. So now if we divide $34,045.50 by $2,129 of depreciation expense, the quotient of which will be 15.99, so we can say that Target's assets have a useful life of around 16 years. So now we're going to be doing the exact same for Walmart's assets so that we can calculate for its useful life in years. That is, we're going to be taking the gross values for property and equipment for Walmart, that is before accumulated depreciation. So we can see here we'll be including all of the values except for land. So if we take the gross value of property and equipment, which is $177,000 and change, and we subtract the $26,261, that will give us a gross excluding land of $151,134 for 2015, and we'll do the same with 2014 to exclude land. And this gives us $146,000 and change. We take again the average of these two numbers to give us $149,000 and change. And we divide this by the depreciation expense of Walmart amounting to $9,100, which gives us an average useful life of 16.38 years. We can round this up to, let's say, 16.4 years for Walmart. And if we compare this to Target's we had previously was at 16 years. So Walmart's useful life for its assets is 0.4 years longer than Target's. Now that we have calculated both firms' useful life in years for its assets, we're going to see what happens if we take Walmart's values and if we use Target's useful life in years instead, and we'll see what effect this has on the income statement and the depreciation expense of the company. So previously we said Walmart's assets have an average useful life of 16.38 years with a depreciation expense of $9,100. Now, if we take Target's useful average life for its assets of 15.99, what effect does this have on the depreciation expense of Walmart? To calculate for the depreciation expense, we take the value of the asset and we divide it by the useful life in years. This is called the straight line method. For this example, we will divide $149,000 divided by 15.99 because we're going to be using Target's useful life instead of Walmart's. This will give us a depreciation expense of $9,319.54. Originally, we calculated Walmart's useful life for its assets to be 16.38 years, while Target's is 15.99. Now, since we're using Target's average useful life of its assets to calculate the depreciation expense for Walmart's assets, we see that the average useful life has gone down, so this is a shorter length that we are depreciating the same assets. So for a shorter life, we can see that depreciation expense goes up. So we can say that there is an inverse relation between the average useful life and the depreciation expense, such that the shorter the useful life of the asset, the higher the depreciation expense will be per year. So we just saw how the shorter lifespan of assets affects the depreciation expense of the company, causing it to increase. Because the company estimates it to use those assets for a shorter period of time, they are forced to depreciate the value of the assets quicker. Now we will take a look at how this affects the income statement of the company. Here on the left column, we have the original values from Walmart's income statement. The revised depreciation expense that we calculated based on the 15.9 years of assets' useful life is around $200 more than the original depreciation expense. That means, since depreciation expense increased by $200, we can expect the income to decrease by just as much. Hence, we subtract the difference of $218.78 from the original income reported to give us the decreased income from continuing operations before and after taxes.
For the first section of the third requirement, we need to find the depreciation expense of Target in the same time period, this time using Walmart's estimated useful life of assets. For this portion, we replace the 15.99 useful years of Target with the 16.38 years of Walmart's assets. We then divide the average of the gross with the 16.38 years of Walmart's useful life for assets to get the depreciation expense of $2,078.48. As we can see on the table, the increase in the useful life of the asset caused the depreciation expense to drop. Part 2 of the third requirement is to recalculate the earnings of target prior to the income taxes and its earnings after January 31, 2015. Here, we start with the new depreciation cost that we calculated for in 3.1. The difference between the original and the revised depreciation amount is that the revised amount is less by 50.52. Utilizing a slightly lower depreciation amount in the same calculations, we can see that there is a slight increase. Income from continuing operations before income taxes becomes 3,703.52, and the income from continuing operations becomes 2,499.52.
That was so much work, and those values seem so negligible. So why might a financial analyst make those adjustment requirements in questions 2 and 3? Interestingly, we saw how adjusting these assets' useful life in years from 15.99 to 16.38, only a 0.4 difference, made quite an impact to the income statements of both companies. It might be in the interest of financial analysts to make similar adjustments as we just did to improve the comparability of financial statements between companies, to compare apple to apple, especially if they're in the same industry. Furthermore, when we are looking at firms' long-term assets, we need to check if the declared useful life is within the industry standards or not. Although it is beneficial in terms of return on investment to maximize the life of an asset, we need to check if the information is accurate representation of reality. Furthermore, we need to check the consistency of financial information that is reported to make sure there isn't any misleading information that the company is hiding.
The last question asks us to define the factors affecting the integrity of the adjustments that were performed in the second and third parts. There are several factors that we can see affecting the accuracy of the method of analysis that we have covered. The first is that the analyst would be assuming that the firms being compared to each other are relatively close. If the long-lived assets aren't close enough already, it throws the method off. Similarly, the factors that affect how long the asset's useful lives are might differ from firm to firm. In recording the depreciation and amortization, what is included in such may also differ significantly. The extent of the depreciation between companies may differ as well. There are a lot of factors to consider when using this method to compare firms, even when they operate in the same niche.
That concludes our presentation on long-lived assets. Thank you for listening.